Hi, this is Ray Evans on the Pegasus team at Infinitas Wealth Counsel, and certainly a lot politically has happened in the last year. It's hard to believe it's only been a year with a new administration, but we've now got to start turning our heads toward market behavior in relationship to midterm elections and how markets tend to do in a typical four-year presidency. And I think this great chart from First Trust really examines what is normal and not normal regarding first year, second year, third year, and fourth year of different presidential terms. And this goes back to 1950, so this is actually a pretty good sample size. And it is pretty interesting. The first year of a new president, markets tend to behave pretty well, as was the case this past year. Volatility perhaps at a minimum. You can see that the average advancement is about 13% in the S&P 500. The average pullback that first year, about 12%. As you hit midterms, sometimes people find a lot of things they don't like about the new president or the current president, and markets tend to be a tad bit more volatile. And so the average pullback in that second year is about 16.5%, almost 17%. And then from that point, a year later, you tend to have a very significant bounce following the midterm elections, typically over 30%, which is kind of hard to believe when you examine that data. So typically the best years of a presidential term, years 2 and years 4, and it just seems that once the midterm elections are over and then there's a little bit of an eye toward the next election, it's funny how the markets tend to do particularly well as you head into people running for re-election, and things tend to get accomplished perhaps in a way with a little more urgency than they are otherwise. Great chart from First Trust. If you'd like a copy of this, ray.evans@pegasuskc.com, and I will get that in your hands. Thanks very much.